Good morning. This is Forex In Four, and today is August the 3rd, 2011. What we're looking at here is the debt deal has gone through, and the market's tanked as a result. And one of the things we can look at here real quick, actually, you know what? Let's look at the S&P 500 because we can see what happened. Basically, here's the announcement yesterday that the debt deal had gone through, and boom, you can see that the market tanked here, and it held just around the 1250 level on the S&P. Which was one of the largest one-day drops that we've seen in some time. Okay, and we can see here, if we look on the daily charts, that the S&P has been down, the last 8 days or so. All right, so we put in a little bit of a resistance up here around the 1350 level earlier, and now we're pulling back. We're just sitting right at the 1250 level, maybe a little bit higher. Basically, what's happened is that the market's viewing this deal as hey, great, there's really not a whole heck of a lot going on here. These guys essentially have just kicked the can down the road, and now let's focus on what's going on in the economies, which are slowing around the globe. So that's one of the major problems that we've seen. So some interesting action yesterday was, if we look at dollar Swiss franc. Now the Swiss franc, as I've mentioned before, has been the safe haven currency du jour, and that's sort of where everybody's wanted it to be. So upon the announcement yesterday that the deal was complete, all right, right in where was it? Right in here. Okay, you can see that the Swiss franc strengthened, okay, right until we got to about this point. And basically what happened here is that this was earlier this morning. I guess they woke up in Switzerland and said enough is enough, and the Swiss bank basically decided to intervene in the currency. And it's not a typical intervention where they just went out and sold francs and bought other stuff. But what they actually do is they popped a surprise interest rate reduction on the market, essentially lowering the 3-month LIBOR targets, all right, and all of a sudden, boom, you got that pop going. So it's sort of like a warning shot that they're sending out. Okay, they're not haven't done any intervention yet, but they're saying, you know what, enough is enough here, people. We don't want the franc to strengthen as much. All right, but you can see here that after this move happened, it started pulling back a little bit, and that's one of the problems with interventions, is that it really is going to take a big move to spook the market to get out of their long Swiss franc position. So as long as people still want safe haven assets, the Swiss is going to be desirable regardless of what the interest rate is. All right, one of the other things we can look at is let's take a look at gold. All right, I mentioned yesterday right over here at these levels, wow, gold looked pretty good, but it's tough to get in and buy it. Well, sure enough, gold is cranking higher as well. You can see here we got as high as 1670s. All right, gold's up about 25 bucks. I think it'll be in short order we'll be up over 1700 here. People are concerned about the inflation. People are concerned about the safe haven assets, and we've seen dollar weakness that's come out of all of this rhetoric and the weakening economy. Basically, people are starting to think, okay, you know what? We're going to see QE2 from Bernanke and the Fed, or excuse me, QE3 from Bernanke and the Fed. We might even see QE4. We might even see QE5. Basically, it's weak dollar policy attempted to ride out these austerity measures. Now, everybody's freaking out because, oh no, the government's got to cut spending. We can't cut spending. No, how are we in Washington going to buy people's votes if we have to cut spending? Well, guess what? It needs to be done. It's unfortunate that it's taken this long and these type of measures to make it happen. All right, but we need to start getting back to fiscal responsibility here in the United States, and part of that could actually happen if the Senate would put out a freaking budget. They haven't done so in 2 years. So it's a shame that we have to take events like this and really force people's hands and go to the brink of the edge, all right, to actually get Washington's work done. So it's really quite an embarrassment in the U.S. here, to say the least. So we're seeing dollar weakness. You can see here, euros popped higher. Where is it? Okay, euros moved up. Okay, we came down just to that 140-150 level, just a little touch there, and we're bouncing higher on euro, although it's pulling back a little bit. One of the reasons it's pulling back is this morning we had the Challenger jobs losses figures come out, and the job cuts have increased. Okay, so what they're basically saying is that we're seeing more jobs cuts happening. All right, not to the levels that we had when the crisis started back in 2008, 2009, but it's still up there. All right, so we've got a little bit of a pullback happening. All right, because the markets here in the U.S. look like they were going to be moving higher. Gold's moving higher, but oil's moving lower. So what that's basically saying is that we expect dollar weakness to happen, and people need a place to stash their money. Stock market's a pretty good place right now. even though there's risk in the market. All right, if U.S. companies continue to downsize, all right, they're going to be able to increase profitability. I hate to say it, but it's true. That's sort of how we're seeing these good earnings right now with 9.2% unemployment. All right, you want to increase your profitability, you just cut the fat at your company. You can a bunch of people, fire them, and now all of a sudden you don't have that added cost. Boom, you don't have to change anything. So we're seeing increased profitability, but on declining revenue. So that's unfortunate, but that's the environment we're in right now, and the government here in the U.S. hasn't done a darn thing about it. They haven't addressed jobs growth. All right, they barely have a budget. They've got all this uncertainty overhanging the markets between regulation, taxes, all this other stuff. And you know what? People who have money and who create jobs can sit back and say, you know what? We're just going to ride it out, wait and see. All right. Meanwhile, the economy starts to get worse and worse as more people lose jobs, or as more people are afraid that they're going to lose jobs, so they don't go out and spend. That reduces consumer spending. All right, we're cutting back in government spending. All right, there's no business investment. Let's face it. All right, so GDP is going to decline. It's going to happen. All right, how do you get GDP to go back up in the face of restricting government spending? Well, you need consumption to go up. You need business investment to go up. Those are really the two areas. Well, how do you do that? Well, it's great to have all these great ideas about, well, we need all this regulation, blah, 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 taxes that need to go higher to pay for this stuff. Well, guess what? You get rid of both of those things, all right? You do it in a way that people don't think you're going to change the rules of the game, a year down the road, all right? You make some long-term commitments to putting people back to work, all right, by not raising taxes, all right, and by not hammering businesses with regulation, and all of a sudden you're going to see them go out and start to hire again. All right, there's a lot of money sitting on these corporate balance sheets, but they have no idea what to do with it. All right, you don't want to go and start, try and open a plant like Boeing did down in South Carolina, only to have the National Labor Relations Board tell you can't hire 8,000 people there. I mean, that's the most idiotic thing I've ever heard, but that's where we're at right now with the state of government in the U.S. So really bad situation going on here. All right, so we've got dollar weakness happening. Let's just take a quick peek at dollar yen here real quick. I'll just show you. We're just settling back in right above the 77 line. We'll just go back to 30-minute chart. All right, now Japanese yen. Japanese yen. The Japanese government warned of possible intervention coming. They've got their interest rate policy meeting tomorrow. That could be a good time that we're going to see it. All right, later this morning we're going to see the ADP employment change. We're expected to have added 100,000 jobs. Now this could be a precursor to what we're going to see on Friday out of the non-farm payrolls report, which is going to be obviously the big driver of the markets this week. All right, so we've got the interest rate reports coming out from Japan, and then also the ECB and the B of E, where no one's expected to do anything there. So right now, economy looks weak. Politicians are weaker. They can't do anything about it or refuse to do anything about it, and we got one big mess here. So dollar weakness is the theme of the day. All right, and watch out for these interventions, Switzerland and Japan, the other safe haven assets. That could keep money pouring into gold, which means we could be back up over 1,700 shortly. So, alrighty, folks, that's what I got for today. Good trading to all.